Thanks very much, Uday. Always a pleasure speaking to you. Is this good time, you think, the market scaling back towards 19,000?
I think you've got to divide the markets into two parts. One is technical, second is fundamentals. On the technical side, markets get driven by money, and we're seeing some foreign money come in, which is, I think, more momentum than long term. On the fundamental side, I think the issues and the challenges still continue, primarily the commodity cycle. And we have to watch that cycle because India has a disproportionate macro impact of the commodity cycle on its real economy and markets.
But suddenly, the kind of flows that are coming in, do you think that's probably the sole factor why the markets have managed to float up?
I think that is one of the reasons. And the second important reason, Shelley, is if you look at our, say, real GDP growth, which is, we can pick a number, 7.5, 8, and then you add inflation. Nominal GDP of India is around 14 to 15%.
Yeah.
And if the rupee dollar, if you look at over the last 2 or 3 years, it has remained very much in the same range.
Sure.
Which means in dollar terms, the Indian GDP is also growing at the nominal GDP rate, which is 14 to 15%. Now, nowhere in the world are you seeing a dollar GDP of any country anywhere near that.
True. So you think that actually there's enough money that's sort of lying around today that is forcing foreign institutional investors to turn to India for lack of opportunity elsewhere?
That is certainly a factor, but also keep in mind the rupee dollar parity as a very important criteria in these flows of money.
Right.
And institutional investors are saying, hey, even if inflation is at 7% for the last 2 or 3 years, we have not seen any significant depreciation of the rupee.
True. But does that bother you as well at the same time? You know, while it's nice and euphoric, suddenly markets up 1,000 points in a matter of a week and a half, the other side of it is that this kind of money can also exit quickly, right?
Absolutely, and that's where the question is about the rupee and the rupee dollar. It has been around the 45 range for the last few years. And if your inflation is at 7-8% versus the US inflation, which is 2%, pure economics says that the differential in inflation rates should reflect in the currencies.
Right.
But it is not.
It's not, that's true. The markets, of course, in India have always defied logic, and you've known this better than me. Do you think that this kind of a wave that we're seeing, for lack of opportunity elsewhere, FI money is coming in, could we seriously look at timing of the market reaching a new high with the turnaround on the rate side?
No, my fundamental view is markets will be range bound in the Sensex levels of 17,000 to 20,000 for most of this year.
That's hardly range bound, I'm guessing.
It's about 15%. So
yeah.
A 15% range where you see one day going to the higher end, another day coming closer to the lower end. But it will fluctuate in this 15% range.
So that means you do expect it to go beyond where we are today, which is up to 20,000
It
mark.
can, but it can also come down. I mean, today we are at somewhere around 18,900 or around that.
Right.
So you have a range, and I genuinely believe it is within this range we will operate.
Do you think that every time the market falls, it's a good opportunity to buy?
I think a lot of factors are at play. The assumptions are that the commodity cycle will not go out of control.
Okay.
Therefore, if oil remains in around the $100, $110 range, I know it is higher today, but the market is hoping that it will be in this range. So
and
that
it's
is
normalized by market standards now.
So, but it's again gone up, as you know, last few days. But if you say if oil remains in the $100 to $110 range, and the policy rates of the RBI, which are currently 7.5% repo, the expectation is they may peak at around 8. So by September, if this happens and
the cycle then turns around,
then the view is we're reaching closer to the end of the rate cycle.
Right.
Commodity cycle will not go out of control. So these are the two very important assumptions on which the markets currently seem to be working. But if either of the assumptions or both the assumptions turn out to be wrong, then you will see a correction or a deeper correction.
True. But essentially by autumn there's expectations of things plateauing from a rate cycle point of view.
That is the current view, but it also depends on how inflation pans out, how domestic growth pans out, and also have one eye watching Europe.